Well, thank you for all coming back. Even more people today, so get out there and recruit more. Um, this particular lesson, I love this lesson because, um, as I said, I am a professionally retired person. It's like most people, you look at their financial life. I mean, you have like infancy. And infancy to me is basically, as long as you're a dependent on other people for financial means, you're an infant. So I hate to, high school kids don't like it when I'm talking about their financial infants, but they really are. They might have money and they have jobs, but they're still dependent on mom and dad to support them. You have financial infancy. Then you have a young person, and the young person's college, getting your first job. Then you have adulthood, when you start getting in your 20s and 30s and 40s, and you're working and stuff like that, 50s. And then you have pre-retirement, which really starts depending on when a person's going to retire, 50s, 60s. And then you have retirement, where you're just living on your investments. And basically, I've been doing that since 1992. So you look at a normal person, if they're retired for 30 years or 35, that's a really long time. Well, hopefully I can live much longer yet, but I've already clocked in, what? If I quit working in 1992, what are we now, 32 years? So chronologically, I should be 100 now. But what's really helped me is bonds. And so in the beginning, I said to be really successful in your financial life, asset allocation is so important. And bonds become really, really important as you reach that retirement age as a diversification tool. So when you're young, you're working, you have something called human capital. And we all, until we die, have human capital. But hopefully you get to critical mass where you can do like I've done, is you can take that human capital you have, which is your talents, your energy, your knowledge, all that kind of stuff, and you can use it for productive things, but you don't have to get paid for it. And I love that. I really do. It's a worthy goal to get to critical mass so that you can just help people. I think it's kind of, we're losing this in the country, is the satisfaction you get of just helping someone and asking for nothing in return. There's nothing better than that. There really isn't. And that's what, getting to critical mass and financial security is so important. But in the asset allocation model, as you get to that land, you need to have something you can count on, which will negate some of the volatility associated with the stock market. So the kind of metaphor you could use is a car. The engine is like stocks. It's going to get you and move you forward. But who wants a car without brakes? Who wants a car without a steering wheel? Who wants a car without their balanced tires and stuff like that? There's so many things, safety features involved in it that'll get you to where you want safely. And if you don't have it, doesn't matter how great your engine is, you're probably going to crash. And going into pre-retirement, so many people make that mistake, is they invest as if they are still going to be working until they die or whatever. And they get to that retirement age and they've accumulated a sizable portfolio and they haven't paid attention to asset allocation. Because I ran into this when I started doing these classes back in 2000, and we were hit with that first nasty bear market. So many people in this class were just said, oh my God, I wish you would have done this class a year ago or 2 years ago or 5 years ago, and I would have known this, because they were overloaded with the stock market. And all of a sudden the stock market goes down 50% and their investments go down 70%. They had, let's say, theoretically, a nest egg of $500,000 and it's down to $200,000. And that's scary. And what happens with people in that situation is people panic, they sell the stock market, which everyone intellectually knows it's a bad idea to sell the stock market when it's at its worst, right? Everybody knows intellectually, but intellect goes out the window when you're scared to death. And you need to have assets in there that give you comfort, that help you to navigate the volatility. That's diversification. Assets that will perform when others aren't performing. And generally, that's where bonds come in. And the sad thing is, people have almost no understanding of bonds. And so they go in. The bond market can be extremely risky. It can be. The bond market, you can lose everything in the bond market just like you can in the stock market if you don't know what you're doing. Lovely example. I was doing this class, I don't know how many years ago it was, at the senior center here, and I was talking about always be vigilant about the quality of bonds you're investing in. And you can tell the quality of a bond you're investing in by simply going to like a place like you're using Vanguard. You can go to Vanguard and you look at the fund on their website, and it tells you the quality of bonds. And bonds are listed by quality by AAA is the highest, and then you have basically AAA would be the highest, and pretty much that's U.S. Treasuries. Then you have AA and single A, and then you have B, but now they make it even more complicated because they'll have triple B, which is basically a lower grade of A. But we'll just, for simplicity, we'll go B, C, D, and then, I mean, that's about as bad as it gets. But if you look at a bond, and you're going to whether it's a bond fund or a newly issued bond that maybe your financial planner is telling you should invest in, ask the quality of it. But anything above here is called investment grade. And I consistently hammer that is so important. Because if you're messing around with bonds in this area, you're defeating the purpose of the strategy of using bonds in an asset allocation. Because if you're in really low quality bonds, and the investment term for bonds in here are junk bonds. Of course, you're not going to sell somebody a bond if you say, we have junk bonds. Who wants to buy junk, right? So the financial service industry, they spruce it up. They have a cow pie, but they put meringue on top of it and they call it high yield. Everybody wants high yield, don't we? Right? Yeah, boy, I want those high yield. I don't want these. They're lower yield. Why are they lower yield? Because they're higher quality. Why are they lower yields? Because they have such credit quality that they don't need to attract you with crazy yields. Don't fall for that game. When somebody is selling you, oh, we have bonds, you're going to get 7% with these bonds. And these are junk bonds. And getting back to my story, I'm doing this class, I'm talking about this, and a lady raises her hand. And she says, well, our financial advisor, we had some bonds, and we bought them from him, and, the yields are really good on these. And what do you think of them? And so she showed me the statement she had and the bonds that were on there. And these were called church bonds. So to give you a history of what these are, okay, so you get a pastor, and he gets together a congregation, and they want to build a church. Maybe they have just a rented place right there. So all the congregation says, yeah, we want to build a church. Well, it's going to cost $1 million to build a church. We don't have $1 million. But what we'll do is we'll issue bonds, and all you people will pay the bond off. All the congregation will pay the bond off over the years. So they get somebody to put together these bonds, and they issue them. and then they find somebody to peddle them. And so that's what these ladies had, this elderly couple. They had 4 or 5 church bonds. And at the time, they had yields like 14%. And this is when interest rates were crowding, a quality one was 5%. And they asked me, well, are these any good? And I said, well, in my opinion, I don't want to own them because there's a reason why that has that yield. There's a reason why. These are very, very risky bonds. Because if that congregation dissolves, the pastor moves on, the church folds, I mean, you're out. And when a issuer of the bond goes bankrupt, I mean, oftentimes you get pennies on a dollar. And it can happen to not just church bonds. Just dial back to the financial crisis of 2008. That's not that long ago. General Motors went bankrupt. And issuers, because I had people in this class, they said, well, what about, I have General Motors bonds and they're listed as B quality. And you're saying that's junk bonds? And I said, yeah. This is before they actually went bankrupt. And then they went bankrupt, and if it wasn't for the government bailing them out, investors only got like 10 cents on a dollar in that situation. That's a bad investment. So bonds inherently, they fit into an asset allocation if they're high quality and you can count on them doing what bonds do. And bonds are inherently not as risky as stocks because bonds are basically financial instruments in which the issuer borrows, you're lending them money. And in return, they promise to pay you back. Unlike stocks, when a company issues stocks, those stocks are issued and people buy them. And after that, they float around and it's exchanged between investors. The company really doesn't necessarily have to pay you back. You know, they basically try to, but because they don't want their stock to go to zero, that's bad for the company. But nevertheless, and it also issuing more stock is a way for companies to raise more money and stuff like that. It's really, basically your stock is a sign of the health of the company. So it's good for a company to have a stock that's strong. But with bonds, you need to have a company that's going to be able to pay you back. And in return for you lending them your money, they promise to pay you interest. And they pay you interest for what's called the maturity of the bond. So the maturity really varies. So now we're talking about the bond market itself. The bond market has all different qualities. That is the first thing you want to check. And then you're looking at various maturities. That's the time between when a bond is issued and when the issuer of the bond promises to pay you back. And right now, probably the universe of bonds that you are going to invest in are either corporate bonds or government bonds. And government bonds, it could be the U.S. government, it could be states, it could be municipalities. City of Oshkosh, the wastewater treatment plant, or they build a new school. I mean, they have to have the money to pay for that, so they issue bonds. And as taxpayers, we pay it off. So there's a whole variety of maturities. So if you're looking at our financial system, one of the things that really helps the government and helps corporations, it's kind of like the grease of the economy, is the fact that the government and corporations are able to raise money almost instantaneously in what's called a very, very short-term bond market, often called like the money market area. So there are bonds that are listed for 90 days or less. That's kind of in the money market area for us as investors. So those are really, really important in our economic system because, like Oshkosh Truck, okay, well, they build the truck, and it takes all kinds of materials, all kinds of labor to build a truck, and they don't get paid maybe until that truck is done. In the meantime, they need revenue to pay the workers and to pay for the stuff, right? And so they can issue short-term bonds and debt in order to pay for those things. And it's liquid. The money's moving a lot. So if you're an investor in that area and you're going through a mutual fund, they are called money markets. The next level is ultra short term. So, okay, we'll start over here with, that's this. Then you have the ultra. And the ultra basically is the 90 days to 1 year. Now that's kind of a new area. I really like that this is available because as you're going to find in this class, having knowledge of what's called the bond market cycle and how it works is really, really valuable in order to minimize the risk of bonds, not just the risk of the credit, but how the change in interest rates affects bonds. And if you don't know what you're doing there, then you're not going to be able to strategize and maximize your profits in that area. So Vanguard, for one, we were in a situation where we had, just a few years ago, ultra low interest rates. I mean, you're talking 0%. And all of a sudden, we went from 0 and we shot all the way up to the overnight lending rate in this country, which is the basis upon most interest rates are factored off of, went up to like 5.5%, very fast. That is a nightmare for bond investors. And if you didn't know what you were doing, you probably had very, very bad returns in bonds. And you could have avoided that if you knew how to navigate in the bond market. And furthermore, these companies now are giving us products to help us. And one of those was this ultra short-term bond fund, which I went to during that part of the interest rate cycle. Then you have, after you have ultra short-term, and I'll explain why. So I'm not just going to tell you that's what I did and not why, but you'll see through this class why I did that. Then on the maturity level, then you have short-term bonds. And short-term bonds are basically 1 year to 3 years. So when you're looking at maybe your company retirement plan, or you're looking at setting up an IRA and you're wondering what kind of bonds to put it into, you're looking at the maturity level of the bond fund as a choice because it will affect what you want to be in at various cycles of the bond market. Okay, then you have intermediate term bonds. And intermediate term bonds are basically 3 years all the way out to 10 years. And then you have long-term bonds. And long-term bonds are basically the 10 years in our country all the way out to 30 years. In England, and they were kicking this around in this country. And it blows my mind. Our government, you know, they're supposed to be really smart people in that Treasury Department. You know what I mean? Maybe they need to come to this class because I just don't understand why in the world, when you're in a situation where you're running huge deficits and you can borrow money at literally 1 or 2%, why in the world wouldn't you take advantage of that, right? Because then you could lock in a bond, because they were talking about issuing 50-year bonds. They do it in Europe. Could you imagine back in the day for us taxpayers when they were running these huge deficits, if they could lock in for the next 50 years, they borrowed money, and investors are willing to only get 1 or 2% interest? I mean, it's not good for the investors, but it's good for us, for taxpayers, right, to have that low of interest. But for some reason, the Treasury, didn't take advantage of that situation. And really, back then, they were issuing a lot more shorter-term bonds, and the U.S. government issues bonds through auction. And most of the auctions were concentrated on shorter term rather than the longer term. And I thought, well, I'm getting off. But anyway, this makes sense to me. Maybe because I get it. When you're a bond investor, you actually have to think like a banker. Most Americans think like a creditor. They look at how much can I borrow money for, and how much cheap can I get it? I think of how much can I lend money and lend it smart. Because that's the name of the game in bond investing. You're like a banker in reverse. You're using your own capital, and so you manage it like a banker would. Make good investments with it. Okay, so in the bond market, you have these terms. You have the credit quality, and you have maturity. So when you're looking at bonds, you can get some idea of what you're investing in, because a mutual fund manager has to, if it says it's a short-term bond fund, he can't be investing in 30-year bonds. If it's a long-term bond fund manager, he can't be buying ultra-short-term bonds, even though he would like to at certain times. Can't do that. He's got to buy what the objective of the fund is. Okay, so that's very, very important that you know this. So another term that's really, really important in bonds, and as we move through this lesson, you will find this is the holy grail of understanding managing bonds to the maximum efficiency, is you must understand this term, and that is duration. That is really, really important in bond investing. And duration basically is the time left that a bond pays, interest. So all bonds have a maturity, but once the clock starts ticking and they paid out a certain amount of interest, they have a time left, and that is the duration of the bond. So when you're investing in a bond fund, let's say it's like an intermediate term bond fund. Okay, so the manager's out there buying bonds probably in the 8 to 10 year range. But if you put together the portfolio of bonds he has some bonds that are going to stop paying interest in maybe 90 days. He has some that are 1 year. He has some that are 3 years. He has some that are 5 years. So what they do is they calculate the average time left that the bonds in a portfolio pay interest, and that would be the duration. So like if you have a U.S. Treasury and you buy it and it's 2024 and it matures in 2034 and 5 years go by, then that bond has a maturity of 10 years, but the duration is the 5 years that are left. You got that? So when you're looking at a bond fund, number one, look at the quality of the bond fund. And it's really easy. Vanguard does a good job of it, because what they do is they identify like their short-term bond funds, intermediate-term bond funds. They use that term that they're investment grade. I love that. And that means you know that there's high-quality bonds inside of it. That's the first thing you've got to check. And then you check the duration. And the duration tells you what's the average time left of a bond in that fund. Because you see, we'll be talking about the risks in bonds. And the bond market cycles. And the managers of bonds try to maximize the risk for investors by managing the duration of the bonds inside of it to take advantage of when is a good time for bonds and when it's maybe going to be a tougher time for bonds. So, and that is by managing the duration. So, I mean, one of the bond funds that I used, I'm not using it currently, but I have used it in the past. It's called a Ginnie Mae. And a Ginnie Mae fund, when it invests in mortgages, and so when interest rates were so low on mortgages, that is an intermediate term bond fund. And when I went to Vanguard's website, the managers had gotten the duration on that bond fund all the way down to like 2 years. In other words, they were shortening the duration. Because this is what you're going to learn, hopefully, in this class, is the major risk you've taken in bond investing is interest rate risks. This is really what professionals do, is they try to figure out the direction of interest rates, because to take advantage of opportunity to create capital gains in bonds. So as I said, it's really nice with bonds because a bond is issued and then you're guaranteed to get the interest. If it's a high quality bond, the issuers guarantee you to pay the interest for over the maturity of the bond. So that's one component in bond investing that you really like. So you can go to any bond fund at Vanguard and they'll tell you what is the yield. Of course, that yield will change basically on what interest rates do, but you get some idea of the interest that that bond is going to pay that year. But then there's also the opportunity to make a capital gain on it. And the capital gain is when the share price goes up higher than what you bought it for. So before I came to class today, I got on Vanguard's website, and as I said, if you know what you're doing with bonds, you can make a lot more money in bonds than you actually believe possible. Because most people think of bonds as, oh yeah, it's like they're glorified CDs. I can get my 3% or 4% in bonds. So there's various bond funds I'll talk about. I said, like the short-term bond fund. Vanguard has an intermediate, or it has an investment-grade short-term bond fund. I looked at the return on that fund over the last, on a one-year basis, is over 10%. I looked at the intermediate-term investment-grade bond fund, which I am using right now in my portfolio. One-year return is over 10%. Another bond fund many people use is called the Total Bond Market Index Fund. The one-year return on that is 7%. Another bond fund that I'll be talking about in this class, because, once again, taxes are important. You got to be really careful with bonds because many, many bonds are taxed both federally and state. And so, like corporate bonds and stuff like that. So even treasury bonds are taxed federally but not state. But paying taxes on bonds is significant because you don't have that potential of 20 and 30% yields, and cutting in and paying taxes is a big deal. So many people are looking for bonds which they can invest in tax efficiently. And the one that I have used in my personally, and which I talk about in this class, is called the Intermediate Tax-Exempt Bond Fund. And the one-year return on, and it's all the interest is federally tax-free in that. So I looked at that, and that has a one-year return of 6%, which is outstanding considering you don't have to pay taxes on it. You might have to pay some state tax, but not federal. That's pretty good. So, as I said, bonds can actually be a growth sector if you know what you're doing. And right now, we're really in a very good place for bonds. If you're asking me about the stock market, I see a lot of risk in the stock market. But as far as the bond market, this is really what you call really the kind of the beginning of of a bull market in bonds, which, once again, I hate to call out things, but the only thing that's going to knock it off its pedestal is if inflation comes back. Because with bonds, as with interest rates are affected by inflation. So as investors, that's why you need to pay attention to what's going on in your life and around you. And inflation basically is, we all have experienced a nasty bit of inflation. And many people fell asleep about inflation because we had very low inflation for a very long time. And all of a sudden, after the pandemic eased up and we got nailed by that 9% inflation, and people were shocked by that. Well, that's one of the reasons why interest rates go up, because stop and think about it. Why would you invest in a bond to get 3% interest if over that period of time that you lent that money, prices go up 9%? What good is your 3%? Because your money got devalued 9% by the cost of living going up. So you weren't compensated. So the bond market reacts to inflation, and that's what moves interest rates up. And not enough people know this, because basically, you ask the average American, it's those greedy bankers. It's those corporations. They're greedy. They're gouging us. No, it's simply interest rates are the reward you get for lending your money. And why in the world are you going to lend your money if the return you get from it is less than what the cost of living was increased? So interest rates have to go up in correspondence to the movement of inflation. And that's basically what would derail the current bull market we're in for bonds. So personally, I think, I never like to say it's in the books, but I think it looks pretty good for a while as far as the inflation thing, especially if we get in a recession. That's one of the morbid things about being a bond investor is like, yeah, let's get that recession going, because, I got 60% of my money in bonds right now. I'm going to do really well. But, I don't like to rub it into the people that are all in stocks, but that's the way it works. It's a nice thing about having an alternative to just having money in stocks. And if you're knowing what you're doing with bonds, we had a nasty bear market in bonds. There were bond funds that were down double digits when interest rates shot up like that. It was really, really a rude awakening to people. But basically, in this class, I warned people for years when we got such low interest rates. And in fact, I still maintained 50% in bonds, but I only did it as basically an insurance policy, because I knew they would hold their value if we had a nasty recession. But I was making virtually nothing in them because they were paying 1% interest, and the inflation rate was higher than that. But I didn't discount my asset allocation model, because at any time we can have a nasty recession. And then that's the price you pay for being in equities. No one ever knows exactly when it's going to happen, and it's usually when you don't expect it. And that's where you need to have bonds. But the good news is you can navigate the risk you're taking in bonds by checking the quality and navigating the duration in bonds according to interest rates. So I should get my charts, and I'll show you how this works. Because basically, this is the holy grail of bond investing, is knowing how to. Well, first of all, I'll show you that I kind of talked about this, but this is the basic risks of bond investing. The risk is that inflation overwhelms the interest rates you're getting in it. Second thing is that the issuer of the bond defaults, and you negate that somewhat by looking at the credit quality of it. And finally, interest rates. The changing in interest rates can, just like you can have capital gains, you can experience capital losses, meaning the share price might have been $10 when you put it in there, and it could go down to $9 if the interest rate cycle is negative for you. So every time I do this class, basically when I did it in high school, I'd motivate them to try to really focus on this by pulling out money. And I'd give them a problem. I would explain how it works, and I'd pull out a $20 bill, and I'd say, any student that followed this, and I'm going to give you a problem, if you answer this problem, I'll give you $20. That got their attention. And I was more than glad to give the $20 away. And it was only to the first one that raised their hand. So they all raised their hand, but the first one that answered it got the $20. But anyway, understanding interest rate risk, if you can get this, it will help you so much as bond investors and managing that part of your asset allocation. So it works like this. People have a really hard time wrapping their heads around it because it's like an inverse relationship to you think how things should work. In other words, we think when the economy grows, when stocks go up, that's really good. But in the bond market, when interest rates go up, and especially the faster they go up, that's not good. That's not really good because it will negatively affect the price. In other words, the direction of the interest rate is inverse to what you want to happen. Interest rates falling, that's good. That'll create capital gains. Interest rates rising will create capital losses, depending on the duration of the bond. And the wonderful thing is that you can adjust your risk, what you're doing in bonds, if you just look at the duration, because it's a simple mathematical formula. Unlike stocks, where there's no absolute mathematical formula you can use to tell you how much a stock is going to go down or how much it's going to go up, in bonds, there's a mathematical formula to help you to figure out the risk and how much potentially a bond could move. And it works, it's very simple. All you have to do is you say, for each year of duration, you multiply the interest rate change, either up or down, and it will tell you how much the principal or the share price of a bond fund or the value of a bond face value will change. For example, this would be a short-term bond. It's a short-term bond. It has an average duration of 3 years, okay? And interest rates shoot up 2%. You take the 3 and multiply it times 2. That means the share price will go down 6%. It's a one-on-one thing. Another example, if you have a bond fund that has a duration, this would be an intermediate term bond, and it has a duration of 5 years, and interest rates go up 1%, that's a 5% decline in principal. If interest rates fall 1%, guess what? You'll collect the interest. So if in 1 year, let's say this bond fund had a duration of 5 years, and interest rates fell 1%, okay? You have a 5% appreciation of the principal, and if it paid 4% interest, you had basically a 9% return that year. A really good return, okay? Now, let's extend that duration. Now you start to see some of the risk of bond investing. You have a duration of 10 years, and interest rates go up 2%, okay? That's a 20% decline in principal. That's a bear market in stocks. Most people, 20%, that's really bad. So this might be a super high quality bond, but interest rates went up 2%, bam, 20% decline. So if you had a balanced portfolio and you had $500,000 in there, a 20% decline on $500,000, that would get your attention, wouldn't it? I mean, it would be partially offset by the interest you still would collect, but still, that's a pretty bad drop in the share price. So the risk you're taking in bonds correlates to the duration of the bond fund you're investing in. So that's why it's really important to do that, to check that out. And Vanguard, like I use Vanguard funds, and Vanguard has really good information on the average duration of their bond funds. It tells you that. It's really, and they also tell you the risk quality. So one of the questions I get asked, and I keep talking about Vanguard, and I think like Schwab is a great company, Fidelity is a great company. I mean, there's lots of really great financial service companies. But one of the reasons why I use Vanguard is simply because at this stage in my life, I'm going to have 50% in bonds or more. And I'm going to have that forever now. And the expense ratio on the bond fund is crucial. And if you compare the expense ratio of other companies to what Vanguard has on their bond funds, game over. Simply game over. They are miles less. And in a bond market, every 1/4% is a big deal. And Vanguards are significantly more than 1/4% less in expense ratios than those companies I said. So to me, with the amount of money I have in bonds, if I can save close to 0.5% just on expenses, that's a lot of money. That's interest that I'm collecting that I would be paying in fees with other companies. So Vanguard does a really good job of getting their expenses down. So that's why, I've got nothing against those other companies, but before you make a decision on where to put your stuff, look at the expenses of bonds because it's really important. I mean, you don't have those 20 and 30% years like you do in stocks to make up for expenses. It's a big deal. Expenses are really important. Okay, so I'm sure you all followed that, didn't you? No problem? Okay. I know you didn't, so I'm going to spend a little more time on this. Okay. To be honest with you, seriously, it confused the bejeebies out of me. It really did. It took me a long time to really get comfortable with this and totally get it. I mean, people would talk to me, and it's like sometimes you have to hear it over and over and over again, and then all of a sudden, it clicks. So I want to give you a living example here to help you to visualize this. So let's take the example of a 10-year treasury right now. So 10-year treasuries, I don't know where they're exact, but I think they're in the 3s, but we'll say it's 4% right now. So today, you went out in the treasury auctioned a 10-year treasury and yields 4%. And the face value is like $10,000. So you give the U.S. Treasury $10,000, and you said that you can use that money basically till 2034 on this date, and they'll promise to pay you back the $10,000. Okay, right away, one of the risks you can see is what's the inflation rate going to be over the next 10 years? Because if inflation is 3%, 10 times 3, by my math, is 30%, right? What's 30% of $10,000? Don't all raise your hand at the same time. I love asking people math questions because they're like, this reminds me of when I was a kid. I don't know what grade I was in, but we were studying holidays. When are holidays? The teacher would ask, when is Christmas? When is Thanksgiving? Kids would raise their hand. And all of a sudden she said, when is the 4th of July? And I was sitting there and I'm like, oh no, please don't call on me. what is the 4th of July? I was like, my mind went, I was like paralyzed. 4th of July, what is it? What day does that fall on? Okay, so you have 70% of that, or 30% means that basically the buying power of that $10,000 you gave the U.S. Treasury is only going to buy $7,000 worth of stuff. So really, a best case scenario is you're going to get 4% for 10 years, or $4,000. So you're going to be slightly ahead, right? But if they're super high quality, people like to know they're not going to lose money. I mean, to show you how fear can really get into people, in the bond market in Germany, when we had like really low interest rates here, the German government was issuing bonds at like 1% and 2% negative interest. People were so afraid of losing money that they were paying the German government to take their money and promise to give it back, and it only cost them 2% to lend it for 10 years. That is unbelievable, isn't it? That's the mindset that people can get into when fear takes over. But anyway, so in this scenario, obviously inflation is a risk. But we'll hopefully we want to make sure we get our $10,000 back, and we're happy to get 4%. Okay, so let's say inflation does come back. And over the next 4 years, the interest rate gradually picks up. So basically, instead of being a 10-year Treasury 4 years from now, 2028, instead of being 4%, the government is now issuing 10-year Treasuries with a yield of 6%. And historically, that's not that outrageous. Historically, the 10-year Treasury usually meandered around the high 4s, the mid 5s, and to 6. It's not unusual to see it at that range. Okay, but we had like 20 years or 25 years where interest rates were so low for so long that people got used to those really low interest rates. That's not normal when you're talking about interest rates. But in this scenario, we're trying to visualize the effect of interest rate changes on you as an investor because you bought this $10,000 Treasury. So basically, 4 years went by. So what's the duration left on that bond? Amy? Huh? 6. You see how she got that? It paid out the interest for 4 years yet. So it only has 6 years left that's going to pay interest to you. But interest rates now are higher. Anybody can go out and buy a 10-year Treasury and get 6% for the next 10 years. In the 6 years that are duration, they can also get 2% more. And who doesn't want to get that, right? And remember, bonds are an investment vehicle, and they can be traded. The bond market is huge. It's enormous. The bond market actually dwarfs the stock market in the amount of money that's in it and being traded every day. It's huge, absolutely huge. So your bond that you're investing in, whether it's through a mutual fund or you own an individual bond, is a vehicle that is tradable. And because it's tradable and sellable, the value also changes. And so we have a scenario here, as I said, which is bad for bonds, meaning interest rates went up. Now, that's going to affect your capital appreciation on that bond or the value of your bond. Because your bond has a face value of $10,000 and it has 6 years left and it's paying 2% less interest than the competitive bond on the marketplace. That's not a good scenario if you want to sell that bond. Okay? Now, the good news is, and that's what bond managers do, is if you hold the bond to maturity, then all this stuff means nothing to you because you're going to get the face value back, right? That's the nice thing about bonds. But if you're trading it or you're an investor in that bond fund, it will affect it. So let's calculate the value of your bond. If you go to sell it, are you going to find anybody that will give you $10,000 for it to get 4% interest for the next 6 years? And the answer is no. And why wouldn't you? Why wouldn't you buy it? It's a treasury. You're guaranteed to get the $10,000 back, and you don't even have to wait 10 years. You only can get back in 6 years. I mean, when I bought it, I had to wait 10 years. You're going to get $400 a year. You're going to get 4% interest for the next 6 years and get the $10,000 back. But you can get 6%, right? So you're not going to give me the $10,000. You're just mean. Just mean. I'm just asking him to help me out here. But in reality, he's making a good business decision, isn't he? Why? I mean, if you go to a bank and one is going to pay you 6%, and the other is going to give you 4% for a CD for 6 years, where are you going to go? The bank that pays you 6, right? And that's what investors are doing. So I need to sell this. My car broke down. I need to fix it. I need to raise cash. All I got is this treasury here. So I need to liquidate it. So what I have to do is adjust the value of my bond to the marketplace so that he can buy it and he'll get 6%. So can I raise the interest rate on my bond? Can I call the treasury and say, I got a problem here. My car broke down. You're only paying me 4%, but now they're 6%. Can't you just raise it for the next 6 years for me? Just be nice. And they're going to, I don't have their number, but I don't think they're going to answer it. But, okay, so you have to adjust from the principal. In other words, you have to take a loss on the principal in order to unload it so that he can break even on this deal. And that is, I have to take money from the $10,000 to compensate. Basically, we're talking about $200 a year of interest, right? Instead of $400 a year of interest, the new ones are paying $600. You following that? So we have a duration of 6 years. And the bond is paying $200 more of interest. I have to make that up. And I can't make it up by raising the interest rate. I have to take it from the principal. So I multiply the duration times the interest my bond is not paying in order to sell it to him for $8,800. And when that bond, so he'll get $400 a year of interest, but when it matures, how much money is he going to get back from the treasury? $10,000. He's going to get the interest that my bond isn't paying from the treasury. And that's how it works. This is how, when you see your bond fund go down in value, it's because the bond funds, or the bonds inside the bond fund, are not paying the competitive interest of the new ones because interest rates went up. And it's all connected to duration. The more the duration, the more interest rates going up affects you. Now we're in a reverse part of the bond market cycle. Interest rates are coming down. So if I change the scenario, and now we see that interest rates in 2026, or 2028, the Treasury bonds are now only yielding 2%. That means interest rates have fallen 2%. Now, What's 2%? My bond's paying how much more interest? $1,200, right? So I can turn around and sell my bond and get $11,200 for it. That's why you see bond funds going up and down, and that's where you make capital gains. So if you pay attention to inflation, you pay attention to interest rates, you adjust the risk of what you're doing in bonds, the interest rate risk, by adjusting the duration. So when we had interest rates that were rock bottom, when we had basically the treasuries the 10-year treasury was under 2%, where money markets and all that were yielding 0. Basic corporate bonds were super low too. The only way they could go from there was up, and I knew that. So I shortened the duration on my portfolio in my bonds to 1 year or less. You could even put it in a money market account, because with a money market account, you actually have the share prices locked in at $1. See, I like money market accounts as a place to park money, because you really won't get any, when interest rates start falling, you don't get any capital gains on it because it's always $1. But it's a really good place if you have rapid increases in inflation and interest rates. The money markets affect the rate of interest corresponds very much to what the Federal Reserve is doing, and it goes up almost on the day, will go up. And so money markets are a good place to park in a scenario like we had. I was comfortable with going with the ultra short term because I wanted to get a little capital gains when interest rates turned around, because you never know when it's going to happen. And now I'm in intermediate term bonds. So as a bond investor, when you're in a situation where interest rates have normalized and they're in a range, or they're falling, a great place to be is in intermediate term bonds to maximize your opportunity for capital gains, and they're also paying a pretty nice rate of interest. Because basically, if you look at the maturity levels, what bonds normally pay the highest rate of interest? It's about risk, isn't it? And the longer you're lending money, the more risk involved in it. So if you're investing in bonds, and you really, if you look at the people that are very high risk professionals in the bond market, they play around in long-term bonds. And I wouldn't touch them with a 10-foot pole, because seriously, I mean, there is a lot of duration risk when you're in longer-term bonds. So the average person, just being able to navigate the interest rate cycle. So keep that in mind. When interest rates are normal and inflation is pretty steady, be in intermediate-term bonds. And you can be in there as interest rates start to fall. But when interest rates get rock bottom, in other words, if we start hitting with, the Federal Reserve, we have a serious recession, and they drop that Federal Reserve rate down to 1% or lower, I'm going to shorten the duration on my bonds because interest rates could potentially, once the economy bounces back, inflation comes back, rise again. And the nice thing is, it's not like stock investing, which is so dynamic, and it's kind of like watching the bond market is very much like watching paint dry. It's very slow. You don't have to say like, when do I do it? Right? Did I miss my opportunity? No, it's very gradual. It's very gradual. For instance, as I said when I talked about performance, I was kind of surprised because I don't pay much attention to performance, but I'm doing this class. I looked at mine and I'm going like, my attention span on performance is I look at my statement and go like, ooh, I'm doing pretty good. That's about it. I don't say, oh, like someone will ask me, well, how much did you make last year? I don't know, but it's pretty good. It's like I can't tell you percentage-wise. But I looked at as I said, I looked at the bond funds, and I saw that the short-term bond fund returned 10%, and the intermediate-term bond returned 10%. I was pretty shocked that it was pretty much the same, but the durations are pretty close on that. One was like 3 years and one is 5. So they're somewhere at, because the short-term bond fund is actually paying higher interest rates than the intermediate term bonds, because the short-term bonds more mimic what the Federal Reserve is doing. Did you follow that? It's like when you're in an inflationary environment, what you often see is what's called an inverted yield curve. So normally in bonds, it's all about the interest rate corresponds to the risk you're taking. And as I said, when you're going to short-term bonds, you're only lending your money for a short period of time. You're going to longer-term bonds, you're talking about 30 years. So there's a lot more risk when you're talking about tying your both inflation risk and credit risk, talking about 30 years. So you should be basically rewarded for that risk with a higher rate of interest to cover the threats of inflation or potential change in credit quality. That's a normal yield curve. Well, for the last 3 years now, we've had an inverted yield curve where the shortest terms are much higher than the longer term. And that's, right now in the short-term bond fund, you're still getting those shorter-term rates are still pretty high. Because even with what the Federal Reserve did last week, they're still 4.5%. So you're still getting a pretty good return in a money market account. But if inflation stays under control, you're going to see those rates come down, and we're going to get, this is a sign of a more healthy economy, to be honest with you. Okay. Anybody follow that interest rate? So I guess what I'm saying is, when interest rates get really low, and by low, I mean you walk into their bank and they're offering 5-year CDs at 2%. That's really low interest rates. Your antenna should go up and say, you know what, I really need to go to shorter-term bonds, because there's a chance that interest rates are going to spike back up. And then I want to be, protected, because they're really low right now. And when interest rates get higher, you want to be in intermediate term bonds until they drop down to that lower level, and then switch to short-term bonds. It's as simple as that. It's not a big deal. It's not hard to figure out. It's very gradual. It takes months, if not years, for a bond market cycle to play out. But especially, think of it this way. Recessions are an excellent opportunity for bond investors. Just the opposite of what it is for stock investors. And that's why when I do that lesson on asset allocation, why bonds play such an important role in modifying the volatility of your portfolio. But they play no role. And I've had people, professionals, set up, they ask me to look at their portfolio. And I see their asset allocation. And I'm going like, oh yeah, it's 50-50. But on the bond side of 50%, they have 30% in high-yield bonds. Well, what do you think happens to high-yield bonds? Because those are companies that are facing bankruptcy. What do you think happens to their bonds when we have a recession? They tank just like the stock market. So when you're looking at an asset allocation that has 30% in high-yield bonds, and that represents the 50% in bonds, you might as well have that portfolio in stocks rather than, because it's not serving the purpose. It's really not. Okay, so let's see. This chart kind of just shows you the effect that not paying attention to expenses on fixed income can really hurt you. These are some funds from some time back. It's a while back I got this chart. But at that time, Fidelity had a mutual fund called the Fidelity New Markets Income Fund. I would venture to say that it probably doesn't exist anymore, because this chart is probably 10 years old. And basically, when it comes to mutual funds, companies, very, very seldom do they keep funds around for more than 10 years. But anyway, back then, this fund at Fidelity had an expense ratio of 86 basis points, well over 0.75%. The yield, okay, this is 2012, so it is. This chart is 12 years old. So at that time, the yield was 4.46. The expense ratio consumed almost 20% of the yield. The Franklin Utility Fund had an expense ratio of 61 basis points with a yield of 3.46. That, once again, consumed almost 18% of the yield. And T. Rowe Price Equity Income Fund had an expense ratio of 68 basis points and had a yield of 2.3. That consumed 35% of your yield. So at Vanguard, the total bond index I looked today had an expense ratio of 0.04. The intermediate term investment grade bond fund that I'm investing in has an expense ratio of 0.10, 1/10 of 1%, 1/10 of 100. So 1/10 of 1%. So very, very low, very, very low, and that's important. So various bonds that I've used and I will talk about to explain that are available to you. In your company retirement plan, most cases, they'll give you choices of intermediate term and short term. One of the choices you can have is a total bond index. So a total bond index is just like a total stock market index, only it is representative of the bond market. So inside the total bond index, you have long-term bonds, you have short-term bonds, you have junk bonds, you have the whole shebang. But because of the diversification, it really ends up as kind of an intermediate term bond fund. I don't use that because I would rather specifically target a certain duration and quality. And so, not that it's not good, it's just that I don't think in this case, it's not like I love this total stock market index fund, but I'm not oversold on the total bond index. I'm currently use the intermediate term investment grade. Well, there's an intermediate term investment grade. It's corporate. I'm not using that one. I'm using the intermediate term investment grade bond fund. So it's not. It has a mix of different things in there. Then there's the Ginnie Mae fund. The Ginnie Mae fund is something that I would potentially be interested in the future. Once again, these are inside an IRA. So these bond funds are not tax efficient because they're fully taxed. But the Ginnie Mae is a very unique investment opportunity in bonds. The reason I'm not using them right now, and I have them use them in the past, and I potentially will use them in the future, is because of the unique features of this bond fund. Okay. Ginnie Mae stands for Government National Mortgage Association. So, this is a investment in which the government says, we want to give people that necessarily don't have the greatest credit quality the opportunity to buy a home and get a loan with an interest rate comparable to someone with high credit. So let's say you don't have a great credit history, but you're hardworking, whatever reasons. And you go to a bank and they tell you that either they won't give you a mortgage or they're going to ask you an insanely high interest rate. If you apply for a Ginnie Mae loan, you can get a loan, even though you have a lower credit quality, a loan of a comparable interest rate to someone that is high quality. So you lend your money to this program. So number one, you're doing a great social service. You're allowing someone, maybe that, is in a little harder times, and needs the help to access money to own a home, which basically adds stability to your life, adds quality to your life. It's awesome. But once again, think back to high school. You know, you had your knuckleheads that asked you for money. You wouldn't lend them money because you're not going to get it back, right? And I'm great for helping people out, but hey, this is my retirement account. I need to live on this too. So I don't want to lend money to someone that's not going to pay me back. With the Ginnie Mae program, remember, this is not Fannie Mae, Sallie Mae, Freddie Mac, all that stuff. This is Ginnie Mae. With a Ginnie Mae bond, the U.S. Treasury says if anyone defaults on their mortgages, forecloses on their loan, whatever, they'll make the bond whole. So you have Treasury quality mortgage-backed bonds here. The highest quality basically in the world is U.S. Treasury. These bonds are Treasury quality, which is awesome. Awesome. So why am I not in them now? I am not in them now because for so many years the mortgage market was crazy and people locked in at 2 and 3% with 30-year mortgages. So this is a bond fund. And the yield reflects the interest paid by the bonds in the bond fund. So you have a lot of people that are paying very low interest. So the yield on the fund is just too low right now. And I checked it. As of today, it was like 3.83%, which isn't horrible. Like the total bond index was slightly more than 4. But if you looked at the managers of that Ginnie Mae fund through this whole cycle on mortgages, they had the average duration on that fund down to like 2 years. So with mortgage rates being well above 5%, you're going to see the yield on this start rising. And trust me, when that yield tips over the 5% area, because the share price is very attractive right now, I'm just waiting for the yield to tick up. I really want to use that fund again. I had used it for many, many years until the mortgage market just went crazy. And it just made no sense to go into there because the yields were just not good enough. And the share price went astronomically high. I mean, crazy high. Of course, I was in it while it ran up, so I was really happy. But I took my capital gain, and I moved on to a different bond fund. So that's knowing this stuff. But put this in your notebook, put this in your mind as something you can put into your IRA that is really a high, getting a Treasury quality bond fund is really, really a great opportunity. And I think that yield will, over the course of this next year or so, tick up into the 4s. And I want to get in on that then. Another bond fund, I'm not investing in them. They're called inflation-protected securities. They're treasuries that pay you an interest rate, and then I think quarterly will pay you whatever the inflation rate is. The ironic thing is they created these things so that people could get a return and they never had to worry about inflation. But the ironic thing is they became so popular that back when we started to have all this inflation, they started paying the inflation rate, but the interest rate they were paying was negative. In other words, people were paying the U.S. government to invest in these. So I just have never dealt in them. I dealt with inflation by shortening my duration, and the shorter term rates were keeping up pretty much with what inflation was doing. I was happy with doing it that way. Another fund I mentioned is the Intermediate Term Municipal Bond Fund or Tax Exempt Bond Fund. is a really, really great place. Like, for instance, I've had people that we sold our cottage, and so we have $200,000. We have plenty of money in the stock market, but we wanted to put this money to work for us. We don't want to just put it in a bank and a money market account. We'd like to invest it in something where, like in a bond fund. That's why I love bond funds, is because they usually pay interest every month. You take that interest and you reinvest it. You buy more shares, and then those shares start paying interest. You get compounded interest. They're really nice. And you can access your money at any time, and you have the potential for capital gains. So anyway, with an intermediate municipal bond fund, the tax-exempt bond fund, you won't have to worry about federal taxes. In my own life, when I was working, I just knew by the time I was in my mid-30s, I knew that I probably wouldn't have to work a normal lifespan, or the normal work cycle for someone. So I really started piling money into Vanguard's intermediate term tax-exempt bond fund. And then when I finally reached that point of critical mass, I understood, and I sold my business. I moved back to Oshkosh, and I bought a house. The guy was building a house. And basically, I took the money out of that bond fund and paid off the house with it, and I didn't have taxes. Most investments you have to sell, you have taxes, because there wasn't any capital gains, or the price was pretty similar to what I had, and so all that interest was federally tax-free. It accumulated, it compounded, and then I was able to sell it and buy a house and not face a big tax bill for paying for a house. Pretty cool. So it's a great place to accumulate money for things, but also if you have a large amount of money you want to put in a personal account and have tax efficiency with it. And another place it fits is if you're in your 50s and you're thinking ahead. It's great to have money in IRAs and stuff like a company retirement plan. But if they're traditional plans, any money that you take out in retirement will be taxed as income. So if you have accumulated, like I did, a sizable amount into something like the tax-exempt bond fund, I would take money out of that to keep my tax rate really, really low. So I would sell certain investments or take money out that were taxable, but it would be such a low amount enough to keep me in a really, really the bottom tax bracket, and the rest of the money I would take out of that and to keep my tax bracket, because you take the money out and you just report it, but it's tax exempt. So I was able to keep my tax rate down really, really low because I invested in that outside of the tax shelters. So as I'm saying, do the tax shelters first, but if you're a super saver like I was and you max out your IRA and you put a significant amount in your company retirement plan, it's not a bad idea to have something like this available to be able to take money out to navigate and monitor your tax bracket. I'll get into a little bit more of that. That's another function of a Roth IRA too. But with a Roth IRA, you're limited to only putting X amount of dollars each year in. This you can put a significant amount in, as such. Okay? Any questions about that? On the money market account, love money market accounts. I'll get more into this when I show you when I set up my portfolio and stuff like that. But my money market account is the place where I park money. And my strategy is I have a pretty good idea of what I need at the beginning of the year. So I'll take the money out of my investments, park it in a money market account, because a money market account I know that the share price is going to be $1. And with the money market account, I get free check writing. So they even give me a checkbook at Vanguard. So I feed my local bank with the money in the money market account. And the money market account is paying, pretty good interest right now. So you're getting significant more than I would in my local bank. But it's a great place to park money. And it's a vehicle for in your liquidity for buying things. And then, of course, I love that ultra short-term bond I kind of talked about. It's an option that helps you if we ever get back into a situation where interest rates crater, we have a nasty recession, and interest rates go down to virtually nothing. Get yourself into that ultra short-term bond fund and protect yourself from the future rising of interest rates will come when the market changes. All right. So, like bond fund strategies, when interest rates are going up, go to short-term bond funds. When inflation is rising, you can always use TIPS and I-bonds. I have not been. Does anybody in here have I-bonds? Okay. When did you buy them? 10 years ago? Do you know what the base rate is on it? Well, I'll tell you. For people that don't know what I-bonds are, because there was a lot of press about I-bonds when inflation was at 9%. I mean, all the financial companies like get into these things. They're the greatest thing. I've stayed away from them. Initially, when they first came out, I-bonds were, like awesome. I loved them. You could go to the bank and you could buy them right at your local bank for denominations like $50. Okay, and what they have is two components. They have a base rate, which is locked in for the 30 years that I-bonds, when you buy a bond, they have a 30-year life. So you get this base rate. And then every, twice a year, I think, they adjust and pay you the inflation for the previous 6 months. So you get a base rate of interest and you get inflation on top of it. They compound yearly. They're state tax exempt. You could use them to help pay for grandchildren or children's college education. They were just like the best thing ever. They were so wonderful. And then they ran out of juice. And they ran out of juice because interest rates fell. And then the base rate went down to zero. And it was there for a very, very long time. And so basically you just got the inflation rate. And then they made it even harder to buy because you couldn't buy them at the bank. You had to set up a Treasury Direct account. And then they started limiting how much you can buy. I feel very proud of the fact that when they first came out with I-bonds back in the early 2000s, I talked about them in nauseam in the first couple of years that I was doing it. And I know one particular gentleman that bought at least $300,000 worth of them with a base rate of 3.6. So he's been collecting all these years, base rate of 3.6 plus the inflation rate every year. So when inflation was, even when interest rates were really low, the inflation rate was still like 2%. He was making over 5% when nobody's making anything in bonds. And then when inflation went to 9%, he was making 3.6 plus the 9 on a completely risk-free investment. Unfortunately, they still haven't raised the base rate very high, and it's almost like the Treasury doesn't want you to buy them. So they're available, but I'm not a big fan of them anymore. And then for taxes, what you want to do is pay attention to what you put your bonds in. So tax shelters are a really good place for bonds, and in personal accounts, you want to go to tax-exempt municipal bonds. And during steady economic times, the Intermediate Term Bond Fund, eventually the Ginnie Mae, and you can even use, if you want to simplify, use the Total Bond Market Index. I'm almost ran out of time here. So, if I put on the board here a bond market question on interest rates, I want to see how many people can answer this question. Okay? I actually think I saw some, you can always tell about how someone's getting, whether they're getting what you're saying, whether their eyes are going, or they're going. Okay, so I'm going to give you another hypothetical, because if you can get this, it's so important. We have a scenario where we have a 10-year bond, and it's got a $10,000 face value. It's 2024. It matures in 2034. And the interest rate is 5%. You're getting $500 a year of interest. So basically, 3 years go by. Interest rates go up 1% a year. Okay? So that basically in 2027, the interest rate now is 8% on treasuries. So you have a duration of 7 years. What's this bond worth? He said it already. Smarty pants over here. He's got a calculator. Yeah, 7,900. Basically, you take the 7-year duration, multiply it times the 3% change in interest rates. That's 21%. 21% of $10,000, $2,100. Subtract it from there, 7,900. Get it? Conversely, if they're 5% and they fall 1% a year, and which is very possible, and they're down to 2%, then it's worth $12,100. The inverse, 7 times 3, 21%. You got it. That's bond investing 101. You ready for the Chicago Board of Trade? Because that's what they do all day. And I mean, the bond market, I mean, they jump all over 2, 3, 5 basis points. It's a big deal. I mean, they go crazy because there's so much money involved in this. Little moves make a huge deal. But for us, we need to pay attention to it in monitoring our asset allocation to protect us and maximize what you're doing in the bond area. Any questions?
So the government's talking about reducing the interest rate at 5%.
Okay, I'm gonna talk more about that in a couple of weeks when I talk about what makes the market go up and down, because the Federal Reserve is really huge in that. His question was, I mean, you're hearing people, oh yeah, they're gonna cut it another 0.5% by the end of the year. It's possible, but why? I mean,
that would affect your bond company.
it's a good thing. Yes, but we see why I said I'm excited about bonds is because we have a long ways to go down. I mean, we were at 5.5%. Now we're at 5. So I mean, it wasn't very long ago we were at 0.5%. You know what I mean? So if they continue, but to be honest with you, I would rather be more cautious about cutting interest rates, because inflation is really something nasty. And in my opinion, the jobs numbers, yeah, they've cooled from insane levels, but we're still creating lots of jobs. Inflation can pop up. It can come back. So a Federal Reserve cutting interest rates too fast is bad. You know what I mean? Because it can rev up inflation. Because remember, if everybody can start buying homes again at 2.5% and cars at 0% interest, those are two huge industries that can really, I mean, this is what kind of really is mind-numbing to me. I've had nieces and nephews that have bought their first houses over the last year and a half. I have one nephew that lives in Rhode Island. He got married, and they've been living in an 800 square foot thing that his wife was living in. And they're desperate to buy a house. And they've been searching for over a year. And the prices are insane. And you would have 50 bidders that were willing to pay cash. And for them to get an interest rate was over 7%. Think about it. You're talking about an $800,000 house, because in Rhode Island the price of stuff is insane. Well, they did finally get a house and it was $400,000, but you're paying 7% of $400,000. What is that? That's $32,000 of interest, isn't it? $28,000. Excuse me. $28,000 of interest. I mean, that's before you paid off any principal every year. I mean, seriously. I mean, they have good jobs, but really, who can afford to buy a house? And yet, you had such demand yet, even at those crazy high interest rates. If you get interest rates down, it's going to be insane. And same thing with cars. So Federal Reserve has to be very careful about rushing. I kind of would like it if they would. I think they dropped it 50 basis points, just because there's been so much pressure that inflation has come down. You need to do something, and so I think that's why they did the 50. But I'll just take whatever. I just hope, because what I like as a bond investor is I don't like to see interest rates crash down and then create inflation and then shoot back up. I like to see a small decline and keep the economy humming and keep inflation under control. That's the best scenario both for stocks and bonds. Then you're doing then my asset allocation, hey, if I'm doing 10% in bonds and the stock market's doing 10%, hey, I'm happy. Yes?
In a bond fund, when the individual bonds within it mature, what happens to it?
That money is then put back into the portfolio, and then the manager reinvests and buy other bonds. So that's the nice thing about a bond fund is, yes, the value of the bonds inside of them depreciate when interest rates rise, but the managers get that face value back when they mature. And then, see, there's so many, I've done both routes. You can go out, like I mentioned about those municipal bonds. Back when I first quit working, I actually talked to a financial guy in town here, and I told him to call me anytime there was a newly issued municipal bond issued by the state of Wisconsin. And if you buy a municipal bond issued by the state of Wisconsin, the interest is double tax-free, both state and federal. And I built a nice portfolio, and I had bonds in there that were paying 5%, double tax-free interest, which is outstanding. You know what I mean? Well, I built this nice portfolio, but then what happened is when interest rates start falling, when you own individual bonds, guess what? The issuer of the bonds call the bonds back and tell you, yeah, you can buy that bond now, but we're going to only give you 2%, not the 5%. So my portfolio basically got decimated by interest rates going down. And then I learned about Vanguard, and I could invest in this intermediate tax exempt bond fund, which has so many more benefits to me as a person. In other words, it's not easy to trade bonds. There can be significant brokerage commissions to sell a bond if you want to sell a bond. So when you're in a bond fund, you have instant liquidity. You can take the money out anytime you want. You have diversification. You're not stuck on one particular bond. You have a professional manager watching over it. And you're collecting interest each month. The bonds that I had paid interest like twice a year. And then, what did I do with the interest? I got the check at home. What am I going to do with it? Spend it, right? But if I have it in a bond fund, it's more, I just reinvest it. So I'm getting more compounded growth on my interest. Because if you get the check at home, it's $100. What are you going to do with it? Oh, I'm going to right away mail it to Vanguard. No, it's $100. I'll go spend it. So I really like having a bond fund. You know what I mean? Any other questions? Yes.
So in our example, we calculated the duration and the cost of the bond, right?
Right.
Are there scenarios where you would sell the bond and then take that duration cost out of the bond and do
Well,
situations where you would just hold it for the 10 years?
well, that's exactly what I did. Okay, with the Ginnie Mae fund. Okay, so when I was in that Ginnie Mae fund, it was paying up to 6% interest. And as interest rates fell drastically on mortgages, that share price just went sky high. For instance, I remember investing in it for under $10 a share. That share price went up getting close to $12 a share. And the interest rates started dropping. It took a while. But I knew the handwriting was on the wall when I got to a certain point where this price is unsustainable, because I looked at the current mortgages being at 3% for a 30-year mortgage, and I'm going like, that's the future, so I'm going to get out of it. I sold it, collected all those capital gains, and moved it to short-term bonds. So if you just sit in a bond fund and interest rates go through the cycle, you have the capital gains, but if you stick in the longer term duration, you give up the capital gains when the interest rates fall. But if you move when interest rates start to fall, you lock in the capital gain, and that money can be used to buy more shares in the shorter term duration, and that that capital gain is somewhat protected. Get it? That's the strategy.
Vice versa, then, if you were...
And that's why the vice versa now, I moved.
You go to long term.
Right. Well, not long term.
Okay, well,
Not unless you want to invest on steroids. But you go to the intermediate. So you look for, like I was at a duration of 1 year. Now I'm at a duration of 5. So I'm picking up that capital gains as the price goes up, as interest rates fall. I think you got it. I think he's got it. By golly, I think he's got it. All right, thank you, and we'll see you next week.